Welcome to Peachtree Point of View. Recently, our team came together to share insights, experiences, and updates that we believe you'll find valuable. Let's jump into the conversation.
Hey, good afternoon, everyone, and thank you for joining us today to discuss current real estate economic and market trends and what investment opportunities Peachtree Group is finding compelling for 2026. My name is Daniel Savage, and today I'm joined by Greg Friedman, Peachtree Group Managing Principal and CEO. Good afternoon, Greg. How are you?
Doing good. How about yourself?
Good. Before we get started, and as always, I'll state that during this presentation, we may make forward-looking statements and that this webinar does not constitute an offer or solicitation to purchase any security. With that, Greg, why don't you take some time to give a current Peachtree Group overview and perspective on what the firm looks like today? We had a great 2025. Love for you to highlight some of the milestones we had and to talk about where you see us going.
Yes, as you mentioned, 2025 was a really strong year on the credit side of the house. I think most people listening are very familiar with Peachtree, but we are a private equity firm that invests across the commercial real estate landscape. We do a lot on the credit side as well as the equity side. And as a company, we've made over $15 billion of investments across the 800 plus transactions. So we've made, I think, 856 total transactions since inception of the company in 2007. And when we say, we've made 856 transactions, these are combinations of us buying assets, developing assets from the ground up. So when we buy an asset, it's us buying like a hotel property and owning that asset, or developing a property from the ground up, or us doing direct first mortgage lending. We make a lot of first mortgage loans. We acquire a lot of loans from banks. And so we've always been very active as a firm over the last 18 years. And, we continue to grow the platform. Corporately, we have over 300 team members. We've got close to 4,000 team members when you look across all the different hotel properties that we own on the equity side. But corporately, we have, well over 300 team members that are helping on the asset management side, the investment management, helping find and source opportunities and so forth.
Great. And then for those who don't know Peachtree Group, can you talk about how we view investing in commercial real estate across the capital stack and what verticals we have within the firm that augment those investments we're making?
Yeah, so we, as a firm, and this sort of highlights somewhat what I was talking about a minute ago, with us really, going out, originating loans, or, doing note acquisitions, us buying loans or making C-PACE loans, commercial property assessed clean energy loans. But we've been very active on the credit side, doing a lot of direct lending. We own a lending platform that's part of the Peachtree ecosystem, where we have loan originators. We do all the underwriting in-house. We have underwriters on staff. We have a servicing and asset management team that's on the credit side, that's focused on underwriting, asset managing, servicing all those loans that we're originating and investing into across our different vehicles. And we have the note acquisition side, which we have a capital markets team that's covering all the banks, where we're buying loans from various financial institutions. So we're buying loans typically at discounts from banks. We just closed on a portfolio yesterday from a bank down in South Florida, where we were able to get a nice discount across this small portfolio of loans. And that's something that a lot of times we source internally through direct relationships with different regional banks and community banks and so forth. And our big benefit as a firm on the credit side, and we do the same on the equity side, where we acquire assets, we develop assets. We have a separate team that's working on that strategy. The reason I mention all this is that we're vertically integrated. So we have teams internally that are that are out there identifying opportunity sets. We're able to provide we're able to do all the asset management, property management, construction management, capital markets, loan servicing. We're doing it all in-house. So we're vertically integrated when we make these investments, which is a huge benefit.
And then, Greg, a lot of today's conversation is going to revolve around how you're seeing the market and really what our thematic approaches are in terms of utilizing the market catalyst to make sound and compelling investments for our investors. Just as a summarization, we're seeing higher for longer interest rates. We'd love to hear your insights on that. Really define what a wall of CRE debt maturities means and how that influences our decision making here, and then really what banks are doing. So I think to kick things off, here we are in 2026 now. Talk a little bit about why these are market catalyst, perhaps headwinds as perceived by some investors? What's happened in the last few years, call it since COVID and onward? And we'll start with interest rates.
Yeah, so it's a great question, and it's sort of a great overview when you think about what's happened since COVID. So when COVID hit, we went from already being in a very low interest rate environment to being at really a 0% interest rate environment. Both short and long term rates had dropped to effectively zero, and as we started having the impact of inflation, interest rates started to rise, and the Fed, started to increase interest rates, substantial. They increased rates, I think, by 400 basis points. And this all, happened, going back in 2022. The Fed started increasing rates. And then typically when the Fed starts to cut rates, when you look at traditional cycles, they cut rates by an average of 300 basis points a year from the start of the rate cutting cycle. This time around, it's been less than 100 basis points that they started cutting in that first year. So we haven't had that catalyst where normally once we start to drop rates because the economy is slowing down a bit, you get that catalyst of lower rates to help spur growth. We didn't have that this cycle. So that's definitely been a headwind, and that's been a headwind in the face of this wall of debt maturities. So we have just a huge amount of loans that are maturing over the next 12 months. And a lot of this is driven through extend and pretend because you had commercial real estate, you had all these owners of commercial real estate assets that were recalibrating, and investors in commercial real estate assets that were recalibrating to this higher for longer long-term interest rate environments. Traditionally, when I say traditionally, really from 2010 to 2022, the 10-year treasury rate averaged around 2.2%. Today, the 10-year is over 4%. It's been over 4% effectively for the last several years. It's averaged, well over 4%. And the short-term rates, even though the Fed has slowly started to drop short-term rates, the federal funds rate, the long-term rates, the 10-year treasury continues to remain elevated, and it's not having much of a positive impact in this face of, of these loans that are maturing. And so what that's causing is a valuation issue, because valuations, as interest rates go up, values drop, assuming cash flows stay relatively the same. And that's what's happened. You haven't seen huge growth in cash flows across most property types over the last several years, yet you've had the impact of higher interest rates, which has dropped the values of commercial real estate assets. And so it's made it a very challenging environment for groups because we didn't get the traditional, Fed cut in rates that traditionally would impact both short-term and long-term rates.
Yeah, so I think you led into probably answering a question I already had for you is, if I'm an investor and I'm, watching CNBC or financial news sources and I'm hearing a lot of conversation around interest rates, what risk-free rate matters, Greg? Is it short-term? Is it long-term? How are we looking at it from a real estate investment lens?
Sure. So I think most investors will look at the risk-free rate being the 10-year treasury yield. That is the most critical. That correlates closer to actual values of assets, of not only commercial real estate assets, but you look at anything that's sensitive to interest rates. I mean, that's a more direct correlation to the actual underlying values of these assets. That's how you really can calculate the intrinsic values of assets and figure out if you're overpaying or underpaying, when buying assets. It's a discussion for us internally as it relates to commercial real estate, because a lot of times we talk about cap rates, and there's typically a risk premium spread above the risk-free rate being the 10-year treasury rate that you would apply in order to value assets. And you can use that as a benchmark to help sort of figure out, what you think the current intrinsic value of that asset is, or potentially the long-term intrinsic value, if you believe that is a cap rate that should, or that rates should remain relatively stable, at least on the long-term side. And so the 10-year to us is something that we pay a lot of attention to. We talk a lot about as we look at making investments, and how that could be a headwind or a tailwind to that investment.
So if we have the house view that interest rates will remain higher for longer, on a relative basis, call it from your post-GFC, nominal interest rate environment, where do you see that being an opportunity, less so as a challenge? Because it's a two-part question. You alluded to higher interest rates, relating to higher cap rates, values of real estate causing some challenges and some pain for owner-operators who bought now what feels like they overpaid for assets. But we talk about credit here all the time. Is a higher for longer interest rate more aligned with a credit strategy focus for an indeterminate, run in the future?
Yeah, so I think it makes investing in a credit position much more compelling, because when we make loans or buy loans, we're buying them at a discount to the current values, and we're able to drive, in most cases, returns that are very similar to the equity side, right? So we're getting these equity-like returns without having last dollar equity risk. So usually we're probably call it a 25 to 30% discount to the current value of these assets when we make that loan. Now, that doesn't mean things can't go wrong and the value drops. Doesn't mean that the value can't grow either, where all of a sudden, they have a lot more equity in the property too. So those values it's transitory. It can change with time based on performance. But the point is to me, it makes it much more compelling being at a discounted level in this elevated interest rate environment. On the flip side of the equation, I know you didn't ask this question, Daniel, but there is a huge challenge to investing capital in this market today. So, I mean, there is an opportunity on the credit side, and that opportunity has existed really coming out of the great financial crisis, and it's only grown because now we're in a more normalized interest rate environment, which means we're in a higher interest rate environment. We're getting higher yields in a lot of cases. And because of all these other macro challenges we've seen, we're getting better, stronger borrowers that we're lending to in general. So the credit side's a little bit more compelling, as well as you're getting opportunities to buy loans from banks because of the wall of debt maturities. We're buying more portfolios of loans as we speak. And so it's a very interesting market for the credit side of the business. There is a challenge on the equity side. And it's not to say that there's not opportunities on the equity side, because there's a lot of opportunities on the equity side as well. And that opportunity set's only growing. But the opportunity on the equity side that existed from 2010 to 2022, we like to reflect on the past, on what worked and what didn't work. We like to understand were we really good at what we did? Were we lucky? Or what really drove the performance? Because I think sometimes people get very caught up in, something was underwritten to perform a certain way, and either you fall, below it or above it. And a lot of times that doesn't tell the full story. Just because you underwrote to be at a 20% IRR, but you end up getting a 30, doesn't necessarily mean that, that sponsor did a great job managing it. And during 2010 to 2022, and really for a 40-year run pre-2022, we were always in this environment where interest rates were falling, and it was a catalyst. It became more of a catalyst coming out of the great financial crisis. And you had a lot of people make a lot of money because interest rates and cap rates kept, dropping and compressing down. And without even growing cash flows, without even being good at asset managing assets, people were able to drive these really outperform. So commercial real estate outperformed on the equity side from 2010 to 2022, just given the fact that you had this huge catalyst being interest rates being so low and continuing to compress down on cap rates, making cap rates, which effectively created the multiples to be much higher across the board for commercial real estate and other asset classes. Now you fast forward to today, you don't have that catalyst. You're now back into an environment where if you're going to invest in equity and you want to drive outperformance, it really comes down to being able to asset manage appropriately. It comes down to being able to create value through, developing a property from the ground up, or buying an asset that's broken and really fixing it, and driving improving cash flows. And you got to make money on the buy side, but you also got to be able to perform well. And so the days of just going out and macro buying the market, which you saw a lot of between 2010 and 2022, because a lot of groups just bought huge portfolios or went out and just aggregated portfolios without any without really a lot of long-term thought to it, and they were very successful. That strategy is sort of slipped away, and we're back into a more rifle shooting environment on the equity side, where you've got to be very strategic and thoughtful about how you invest. There is a lot of, beyond making investments on the credit side, there's a lot of special situations that we're seeing where groups are, they don't have enough capital to effectuate their business plan, or their business plan is moving because of, these loan maturities, and they need capital to pay down loans, or they need capital in order to, help effectuate a purchase. And they're willing to, put their capital in a subordinate position. You can come in as preferred equity, or, you can come in a position that's at a discount to the current value of the asset, that's just driven by these challenging and these headwinds in the market that we've talked about, with having higher for longer long-term rates, as well as this wall of debt maturities.
Yeah. So Greg, just while we're on the slide with a risk-free rate demonstrated here, we talked a bit about cap rates. If you were to draw a line on this graph where cap rates are right now relative to the 10-year treasury, I guess, first of all, where would it be and what would really realistically be the appropriate risk premium spread between a risk-free rate and what you should be getting paid for taking on real estate risk?
Sure. So in general, you should be getting, on average, across commercial real estate, you should be getting 275 basis points above the 10-year treasury rate. That should be your average cap rate when you look across all commercial real estate property types, including multifamily, hotels, office, retail. That's the historic average. Now, it doesn't mean every asset should trade at a 275 basis points risk premium spread with with the 10-year at roughly 4%. That would put the average cap rate at 6.75. Some assets would trade, within 6.75 because maybe you have a strong corporate credit, maybe 7-Eleven, like you see a lot of these 7-Eleven triple net leases, long-term leases that, they're trading, within a, 6.75 cap rate because, you have investment grade tenants and so forth. Or versus an office building should trade probably above it, because it's riskier. It's got some challenges depending on the tenant turn and things like that. Hotels tend to trade above it as well. Historically, hotels trade with 300 to 400 basis points of risk premium spread. So it's it does vary by asset class depending on the durability of the income stream, and that's a big factor. And so that, as we just talked about market conditions, that is something we spend a lot of time because it's very hard on the equity side to make sense of some of the trades today because you do see a lot of assets still trading probably too compressed within that historic range. Like you're seeing assets trade, in the 5.5 cap rate range. And that's only giving you 100 basis points of risk premium spread, and I'm really alluding to like multifamily assets, for instance, right now trading at 5%. And even in some cases within a 5% cap rate, you scratch your head because it's not a very sustainable long-term trade because eventually we think if the 10-year stays elevated, you're going to slowly see the reverse of what we saw between 2010 and 2022. You're going to see cap rates slowly expand out as the market has conviction that the risk-free rate, the 10-year treasury rate, staying above 4% long-term.
That's a tough argument, buying something at a 5 cap and financing it at, an interest rate that's north of that 5.
That's right. The negative leverage.
Tough. So this next slide is really compelling, and it's the second market catalyst I'd like you to dig into today, Greg. But I want you to look at it from both sides of the loan document. I want you to look at it through the eyes of a borrower, and I want you to look at it through the eyes of the existing lenders. So, as it states, $2.5 trillion of CRE debt maturities are coming due between really 2025, as this graph shows, and the end of 2028. That's a lot of paper. What's happening, first of all, on the borrower side? For an asset that they paid for or financed in probably a nominal or a lower interest rate environment, what is their experience and what are they having to do right now?
Yeah. So one thing to note is that it's really front end loaded. When you look at the loan maturities, on average, historically, you have $300 to $500 billion a year of loans maturing over the next 12 months. You have close to $1 trillion of loans maturing. So this is an unprecedented amount of loans that are maturing. And so you have a lot of borrowers that are experiencing this right now as we speak. And we see it all the time because we're talking to banks about buying loans where the borrower's faced with a loan that's maturing. They bought the asset several years ago. So say they bought it back in 2021, they bought it in a totally different interest rate environment. Now interest rates are much higher. Value is down on average by 20% across all commercial real estate property types. So assuming they bought it for 100 million, now the asset's only worth 80 million today. They got a loan when they bought it for 100 million for 70 million, even though the asset's still worth more than the loan balance. The bank is coming to you and saying, look, we originally gave you a loan at 70% of value in this example. We need you to right size it back to 70% of value because at an $80 million valuation today and a $70 million loan, you have an 85% loan to value loan. The borrower is like, I can't pay down the loan by $14 million in this example to get you back to that 70% of value. And so it becomes a negotiation, or they've got to look for alternative ways, or potentially just be forced to go sell the asset. So they're looking at, how do I handle the situation? Do I take capital from, do I take on preferred equity? Do I, do a capital call to my investors? How do I manage through this situation? So it's It's a very challenging environment. In some cases, the differential may only be, in that $100 million example, maybe the value hasn't dropped as much, or maybe cash flows have grown some. And so the value's down substantially less, but they still got to come up with cash. And so it's a very challenging environment from that perspective. The good news is, there are options out there for borrowers and owners of assets. And so it really comes down to, really having a very solid plan if you're a borrower to be able to refinance. And so if you have a very strong performing asset like that is stabilized and it's ready for the, permanent market, there's a lot of liquidity for those assets. For transitional assets, like the example I just gave, there is less capital available for, and that's where we really shine today.
Yeah, and that's the one thing I wanted to ask too, Greg, is when you think about the assets and you think of value dilution that's happened as interest rates increased, that sounds more like a balance sheet issue or a debt service coverage issue than it does a fundamental property issue. Would you say that that's accurate?
That's right. I mean, this is not a, it's not a property issue or an asset level issue in most cases. This is all balance sheet driven right now.
Yeah.
Like this environment, for the most part, is balance sheet driven. I mean, you do have certain situations where certain submarkets are challenged because of some of the political environments. But for the most part, I would say across the U.S., most markets and most assets are performing relatively well. It's just the challenge is balance sheet side.
Yeah. And this next slide, leans right into that. So for borrowers who are looking at a refinance with their current lender, what does that look like? I mean, they were borrowing at almost nothing 5 years ago and are now coming to the table where, I probably have never heard the words cash in refi so many times. You always hear the opposite. That poses some challenges for borrowers or owners of assets, if they're not going out to their investor base or they can't come to the table with that capital. What does Peachtree Group do in that place?
Yeah, I mean, if a borrower can't come up with the capital, I mean, the reality is most cases we're not going to get there either, right? Like we're not going to be able to help them. But that's why in a lot of cases, we're coming in providing senior loans to borrowers that are doing cash-in refinances in many cases, where they're bringing in an additional partner. We're doing some stuff on the special situation side where we'll do a little bit more stretch and we'll do preferred equity. That's another way, if it's not through our credit strategy, it's more on the equity side. But it's a very constructive discussion when those events occur.
Sure. Greg, when you look at the banks right now, we talk a lot about, there's been some issues and some regulatory pressures. What have call it the primary lenders of commercial real estate loans, i.e. the regional bank space. What have they done over the last few years? Why has that been an opportunity for private lenders such as Peachtree Group? And kind of where do you see that market going?
Yeah, so a couple of different things. One is, there's been a lot of bank consolidation, and we talk about this a lot, but you had 15,000 banks like 40 plus years ago. Today, you have closer to, 4,000 banks, and you'll probably have closer to, 2,500 banks 5 years from now or whatever the case is. But you're going to continue to see bank consolidation, and 1 + 1 does not equal 2 in lending capacity. So the lending capacity coming from the regionals and the community banks is quickly evaporating as they continue to merge together, and they continue to have regulatory, constraints, just given in a less regulated environment under the new administration. We're still seeing that regulatory constraint that they have. And so they're not able to appropriately service their typical traditional commercial real estate customer. And that's why we're seeing a lot of borrowers come to us, as well as we're seeing a lot of banks trying to sell off exposure. What they are doing is partnering with groups like us. So there's more of a symbiotic relationship between us, where they're providing note-on-note financing. They're doing, other structures, maybe AB structures, or even credit facilities, to still get exposure indirectly to these loans, but they're not able to do the traditional loan because they don't want to fill up their CRE balance sheet and their commercial real estate exposure. They can take it as a C&I, and it helps them from an accounting treatment perspective. And I think that's just going to be a growing trend as banks, the regional and the community banks, are way outweighted compared to the nationals on exposure to commercial real estate, and they're going to find ways to, continue to reduce and deleverage their exposure there.
So, Greg, looking forward into 2026, here we are in January, and I'll tee you up maybe for some forward-looking statements or some prognostications. We talked about higher for longer interest rates. We talked about the wall of debt maturities, and we talked about banks having pulled back over the next few years. Do you see that being a consistent theme across 2026? And how would you summarize, and we'll go into the, what offerings and what strategies we're utilizing here at Peachtree in the next part of this presentation. What do you see in 2026 if you had the crystal ball?
Yeah. So I think 2026 is going to be, the first half is going to be very similar to what we saw in 2025, where there's a bifurcation in the marketplace that continues to grow the first half of the year. I think it's going to be a very challenging year for certain groups. So if you have loans that are maturing, if you're, if you have an asset that's underperforming, it's going to be a very challenging environment. But I'm very bullish on the latter part of the year because I think you've got a couple of tailwinds that are going to start to show and really show up in a positive way. And a couple of these are the fact that there's really no new supply getting delivered. So there's very little new supply across the U.S. getting delivered over the next several years. And I think that's going to be the case probably for the next 5 to 7 years. So when you look across all the different property types, supply growth has dropped, in half or more across the different property types. So it's very minimal. When I say it's dropped in half, it's dropped in half from historic averages. So, demand's continuing to grow for most property types at some level. Supply is not getting delivered at the same level. So at some point, you're going to see that all the new supply that was built is going to get fully absorbed. But more importantly, you're going to have a lot more pricing power. And I think that's going to start showing up in the latter part of this year. I think you're going to have a big positive impact from the new tax bill. I think that's going to be another tailwind to the environment that's going to show up here in 2026. And that's going to help consumers. It's going to help, businesses and so forth. So I think you're going to see that be another positive tailwind in the latter part of this year, along with the fact that I do believe we are going to continue to get some interest rate cuts on the short-term side. I think long-term rates stay elevated, but you're going to get some relief on the short-term side, which should be, somewhat of another catalyst to the marketplace itself. I think you'll see a more stable, like the first 8 days of this year has been anything but destabilizing as we talk about political and just what's happening economically with Venezuela and then some of the other things that are taking place. But I do believe as the year takes on, we're going to have a much more stable environment. We're going to have a much more stable, predictable Fed. So once we have more predictability to where the Fed is headed with rates, both, what they're going to do on the short-term side and how that's going to impact the long-term side, I think that's going to give conviction to the market to actually trade assets. We're going to have a much more active environment on the trading side where you're going to see assets really start to churn, which is another tailwind and positive to the marketplace. So I'm very bullish that the latter part of this year, we will see the market start to stabilize out. And that's going to create, a lot of investment opportunities. It's going to create opportunities for legacy portfolios to potentially, sell at better valuations or in a better environment. And so I'm bullish, where the market is headed. But I do think we're going to continue to have, it's going to continue to be a grind over the next, 6 to 9 months. But it's, I think we're heading in the right direction and clearer given how challenging this environment's been over the last 3 years.
Yeah, that's fantastic. And, I really look forward to, seeing how we're going to navigate some of the interesting components of 2026.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.